This is the Smart Beach Investor Podcast, where we explore how investors leverage real estate at the beach to live big lives and build their personal wealth. If you are an investor at the beach or you want to be, you found the right place. Enjoy today's show and be sure to subscribe to the podcast so you never miss an episode of the Smart Beach Investor.
All right, so Katie, we have Andrew Martin here with Atlas Financial Strategies. He's going to talk with us in a little bit about how to build wealth, how to protect your wealth, how to do all kinds of stuff to help our folks really increase their positions.
Super excited to talk to him today.
Yeah, he's a smart guy. It's going to be good. Before we jump into that, though, let's jump into what's going on in the market as we've seen it over the last week or so here. Year over year, we've seen the prices of properties here on the Emerald Coast just skyrocket. Take a look at the Destin homes there, up 57% year over year. Unbelievable what's happening. Unbelievable across the board on condos and houses. And that's causing a lot of sellers to think twice about what they're doing. Should they hang on to it? Should they sell? And it's causing a lot of people to get weird. We're in that time in the market where the money's so big that people are starting to get crazy, and it's something to watch. The other thing that we're watching, as you know, is interest rates. And from what I'm seeing, Katie, everything indicates you're going to see rate increases here through the rest of February into March and beyond that. The Fed's going to keep pushing that, which they have to do. They have to do to fight inflation, right?
I think I got in just in time with my refi.
Yeah, you did a refi last week, right?
Yep. We just closed on Friday and I snuck it in there.
Yeah, very smart. Smart, because they're going up. By all accounts, they're going up. And also, what you got in the fall, we have an election coming up.
Mm-hmm.
Elections always stunt things. People wait and see what's going to happen. So I would expect that combined with prices, as we saw, prices have jumped so much. And then the price of money, as we just mentioned, is gone up. So I would expect it to be bonkers here through March, April, May, June, probably right up to the end of July, but then come into the fall, probably first part of next year.
A little slow down.
Yeah, I think just because everything that it'll cause some drawdown in demand, which will stall out prices, and we might even see a fall back in prices. That's what I'm looking at. Maybe Andrew sees something different, but I would expect later this year, first part of next year, that we see some pushback in prices. So that's kind of what's going on right now. Until then, though, bonkers. If you're a seller and you're going to own this thing for less than 5 years, absolutely sell right now. We know there's a demand. We know the market's hot. We know prices are still high and money's cheap. We can sell at a high price. What it's going to be in a week, probably got that. Next year, pretty dicey. 2 or 3 years out, all bets are off. So if you're going to own this thing less than 5 years, what are we doing, Katie?
Sell now.
You should sell now, mitigate your risk. If you're going to own it longer than that, who cares? Ride it out, watch the market. Let's do whatever you're going to do. Enjoy the show. Okay? That's where we're at always, right? Let's bring in Andrew. Let's see what Andrew's got going on. Smart guy, this guy. I follow him on Facebook. If you haven't done that, you should do that. Offering up tons of stuff. Andrew, how are you, bud?
I'm good. How are you?
I'm doing great. Andrew, tell us a little bit about your operation over there. You're growing huge. You're already crushing. Tell us what you got going on.
Thanks. Yeah, we're a fee-based financial planning firm, so we charge for our time and advice, and that's important. You should know how your financial advisor or planner gets paid, because that will color the advice that you get. So we think that's an important distinction.
Pretty sure free stuff isn't worth all that much.
Yeah, if your advisor isn't charging for their time and advice, in our opinion, generally whatever advice they give you has to be something that makes them money.
Yeah, for sure. Love it. So, all right, Andrew, I'm just going to fire some questions at you. I want to get your reaction to what we got going on here and see if you can help our clients. So what we have out there, Andrew, is owners of properties here at the beach, right? They bought them as second homes, third homes, investment properties. Sometimes they use it for a couple of weeks a year. Sometimes they don't at all. They're just renting them out. Sometimes they don't rent at all and they use it all the time. But my question for you from a wealth management, a wealth protection, a wealth strategy standpoint, I just want to get your take on these things. You all right if I fire a couple questions at you?
Of course.
All right, cool. So here's what I wrote down. 3 things, Andrew. What 3 things would you emphasize to owners of properties here at the beach right now from a wealth building standpoint? What would you focus on if you were these folks?
I would say, particularly if you're an out-of-town investor working with a good real estate professional that knows the market, is extraordinarily valuable. 2, asset protection, I think, is very important. Obviously, right, if you own the property, whether you choose to have an umbrella policy or own it in an LLC or a trust or something like that, but asset protection, I think, is very important. And then 3rd, I think the long-term planning. So, what is the purpose of this property or investment? Is it to, hold for a certain period of time and then sell? Is it to pass down to kids or grandkids or what have you? And that's probably where the need for long-term, planning comes. I mean, obviously, if you plan to just hold on to it for a handful of years or however long and then sell it, the need for, some good estate planning may not, long-term estate planning may not be there as much.
But here, let me jump in.
Sure.
People have tragedies hit them all the time, right?
Absolutely.
Unexpected tragedies.
Of course.
Okay? So if you're planning on doing estate planning, you should probably jump on it, don't you think?
Oh, I agree. I'm not saying that the need for estate planning isn't there, but just, some of the longer term, because there's a lot of things to think through, right? Who gets the property? Let's say you have 2 children that you plan to give it to. How do they get it, and what are the rules behind that? How long do you want them to keep it? All those things. Let's say, child A and child B. Child A wants to, sell their part in the property. Well, then does child B get first right of refusal to buy that?
We see this all the time. People
just
throwing it out, throwing their parents under the bus or other family members. It's ugly. It's uncomfortable, but it's marketable, right?
Yeah, and I think nobody wants to give it to their kids and grandkids. I mean, I think the rationale, if they're doing that, is for their heirs to be able to enjoy the property for a long time. I mean, that's probably the whole point of it. But without good, thorough, thoughtful planning, what is meant to be need for good, thorough thought is very important.
Got it. So, can you recap that, Andrew? You froze up on us.
I did. Yeah. I wonder what's. I guess that's my camera. So again, I think with people, if they plan to give this investment of property to their kids and grandkids and things like that, it's generally, I would imagine, meant to be a source of joy for their heirs.
Sure.
But without thorough and thoughtful long-term planning, it can end up being a source of discontent.
Sure. On a lot of, not even just children, spouses, right?
Right.
Same story. Make sure you got that stuff tied down. Okay, we're back. We had some brief technical difficulties there, but it looks like we got it fixed. We're going to be talking to Andrew over the phone the rest of the way. So let's just jump back into it. I think, Katie, you had a question right before we jumped off there. What were you saying?
Yeah, so what I was saying, Andrew, is that what we're hearing from owners over and over right now is I would sell, but where would I go? I don't want to get hit with these big capital gains bills. So what are some options for them? A 1031, a DST, an opportunity zone? What avenue should they go down?
Yeah, and it really depends on, obviously what their goals are. But what a great problem to have a ton of capital gains.
Right.
But, if they want to continue, investing in real estate, there's, but maybe, so there's DSTs, Delaware Statutory Trust. And so I can briefly explain what those are.
Yeah, I don't think most people know what a DST is. It's a little bit esoteric out there, at least in my world.
Yeah. So a couple important things to know. You have to be an accredited investor, which means you have to have income of at least $200,000 for a single person, $300,000 for, filing jointly, or a net worth of at least $1 million. Which I imagine people investing on the beach probably,
probably are. So who gives that credential? How does that occur?
Say that again?
Who gives that credential? How do you get that? Like, do you fill out a form and send it to the IRS or something? Or how do you become an accredited investor?
Yeah. I mean, you basically got to be able to prove income or net worth.
To who?
To the, let's say, the DST firm or something like that.
So the individual firm will require you to fill out some paperwork to make sure you have money. And basically what they want to do, correct me if I'm wrong, but my belief here is they want to make sure that you, as an investor, you can afford a loss, that this isn't going to crush you, that you have the financial means to ride out a down cycle. Does that sound right to you?
That's probably part of it. They want to make sure that you're a quote unquote sophisticated investor, that people that have a higher net worth or higher income hopefully are doing their due diligence before making an investment. So
fair enough.
But yeah, a DST is kind of like a real estate syndication, or kind of like a REIT, a real estate investment trust. So it is a portfolio of properties professionally managed, and so they can own Class A apartment complexes, Amazon warehouses, medical buildings or hospitals, or things like that. Things that the average person could never invest in themselves.
So you're basically getting a piece of that, not the whole thing. You don't get the whole property; you get a piece of it. That's right. Yeah, you're getting a percentage ownership of that. And it's 1031 eligible. Perfect. So, you can 1031 over into that. Now, it's generally going to have a holding period of anywhere between 2 to 10 years, generally 5 to 10, but, sometimes as little as 2. Is it paying out a dividend or any type of return in the meantime? Yeah, it pays monthly income, and for all intents and purposes, it's just like owning a piece of real estate. So, I mean, you get to write off, depreciation, amortization, things like that. Right. So again, it's just like owning real estate. You preserve your step up in basis, which is really important. Huge. Yeah. So, I mean, those are, the fact that you're able to 1031 into it is professionally managed. You get to, again, write off depreciation, amortization, all those things. So who does that? Do you do that? Are you the go-to on that? If I have a seller wants to sell but can't find anywhere because there is no inventory, they got nowhere to go, so they're not going to sell and they don't want to take the hit on the capital gains, can they call you and say, hey, tell me about this DST stuff? I have some interest in that. Yeah, and there's multiple DST firms out there, and DSTs that we may be able to help them sift through some of those. But yeah, the short answer is yes. They can reach out to us and we can kind of walk them through those things if they'd like. But it would be a good person, I think, or it would be a good fit for the person who, as you mentioned, real estate market is incredible. Maybe they want to sell, and maybe they want to 1031. The problem with 1031 right now, if you wanted to do it to another property, is that inventory being as low as it is, and you have 45 days to earmark the next property and 180 days to close. So finding the next good deal may prove to be difficult. It can be, right. And then if you don't, and then if not, it all kind of falls apart. So the DST, again, do your due diligence on the DST, 1031 into there. Again, just like owning real estate. As far as the tax treatment and all those things, nice. Right? And they're available, right? It's not a inventory situation in that case. Is that fair? That's right. Yeah. So I mean, there's plenty of them out there to be able to invest in. You should be able to kind of have your pick. But it would be a good fit potentially for somebody like that. That's like, well, I want to sell this property. I'm going to realize a ton of gains. I still want to invest in real estate. I don't want to pay the taxes. So 1031 into a DST, for that 2 to 10 years or whatever it is, maybe as a holding period until you can, earmark, the next piece of property if you choose to do that. And you can jump out of the DST into a new property, right? Same thing. Say that again. I'm sorry. You can jump out of that DST too at some point and back into a property via 1031, right? That's right.
That's right.
Yeah.
And we find it sometimes for people who, have been real estate investors for, a long time, and maybe they're getting closer to like retirement age or something like that. And they just, they don't want to, invest in the properties themselves, but still want to invest in real estate. That might be a good, it's very, 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 very passive. They just don't have to, quote unquote, deal with any of the issues.
The property management, the maintenance, all that stuff that's handled by somebody else, right?
Say that again.
The property management, the maintenance, the day-to-day worries are all somebody else. You don't have any of that.
That's right. Yep. Somebody else is doing that for you.
Cool. Hey, Andrew, opportunity zones. I was talking to a guy the other day. He said he sold last year and rolled his money into an opportunity zone. But I don't know. Is that a good way to go? Is that a tie-up? I think we were talking off mic or whatever. You said maybe that's tying you up for 10 years or something. Is that? Tell me how that works.
Yeah. So to get the full benefit of the opportunity zone, you have to. So any gains that you make, so whether it's selling stocks or real estate or whatever else, you realize a capital gain. You have 180 days to basically roll that into a qualified opportunity zone.
Okay.
And then you can defer the gains.
Okay.
But to get the full benefit, you got to hang on to it for 10 years. And if you do so, then to make math really simple, let's say you have $100,000 capital gain that you'd like to defer for whatever reason.
Right.
Investing into a opportunity zone. At the end of that 10 years, assuming you hang on to it for 10 years, you would pay capital gains taxes on 85% of the original gain. So you'd pay capital gains taxes on $85,000 instead of the original $100,000. And then any gains that $100,000 made in the opportunity zone would then be tax free. But
and
then
in theory, these can make a pretty good gain
if you're holding on to it for less than 10 years.
Got it.
It doesn't get the same tax benefit, but you still do get some.
And Andrew, these can make pretty good gains too, right?
Yeah, absolutely. Because they're as the name would suggest, they're investing in like underserved communities and things like that, and a lot of potential for appreciation. Right. So yeah, I mean we've seen some that have done really well.
Cool. I'm going to ask you another question, Andrew, and this comes up all the time. You don't want to let the tax tail wag the dog. Is that fair to say?
Right.
I think people get tied down.
We see that sometimes where, people might be talking to us about, let's say like, charitable remainder trusts or something like that. Again, how can I avoid paying taxes, on this gain? And it might be the sale of a business or the sale of, some real estate or something like that. And, with every gimme, there's a gotcha. So to your point, you don't want to let the tax tail wag the dog. So you don't want to, do something strictly for the sake of saving taxes, which is important and we all want to do, but to the detriment of, something longer term or something that is ultimately, maybe more important. So yeah, absolutely. I mean, save taxes obviously where you can. That's a big concern, as you can imagine. That's a big reason people come to us is how can we not avoid paying taxes? How can we minimize our tax burden, and different ways to do that. But again, with every gimme, there's a gotcha. So we just got to explore options and try to figure out what's going to be, the best fit for this person based on their, shorter term and longer term goals.
Perfect. So Andrew, the way we operate here, right? We're talking to these owners, right, Katie? We talk to them all the time. You're
Daily.
talking to them, all the time. And what we're trying to do is get an understanding of what their goals are for the property, long-term, short-term, whatever, and just understand what they're trying to do and what our role could be in helping them achieve that or move it forward. I think that's what, and we're doing it from a build the wealth through real estate by selling and pocketing profits or rolling it into the next property for even greater wealth and all that stuff. I think that's what you're doing too, right? You want to talk to people, and I'll let you talk about this, but I believe, because you and I talked about it, you want to get to know what folks are wanting, hoping to do. And so you can then apply your knowledge, expertise, and skill to help them achieve whatever that goal is over a long period of time, in theory. Does that sound like what you do? Very similar to what we do?
Yeah, that's right. So we, again, the first few meetings that we have with people, and we spend a lot of time with clients because, to your point, it is very important to, at least in our opinion and y'all's too, it sounds like, to understand, what makes a person tick, how they make decisions, what's important to them in the shorter term and longer term, and what their goals and dreams and aspirations are. And only then, once we have a good understanding of those things, do we feel like we can provide the best advice and service that we can. But it doesn't, again, the way that we structure the practice is such that if you want to make your wealth in real estate, that's great. If you want to make it with stocks, that's great. If you want to make it with your business, that's great. Or other types of assets, it doesn't matter to us, right? Because we're charging for our time and advice, and we'll help you along with however it is that you want to invest. And again, I think that's an important distinction because if I had to estimate, I'd say probably 95% or so of the of the people in this industry. If you don't want to invest in a stock bond portfolio or something with them, or some other type of way that they're able to make money directly from you investing in that thing with them, they're not interested in working with you because they can't make money. And
sure,
most of the large firms that everybody knows the names of don't have the capability of
I tell you,
charging planning fees and helping clients in the way that, and we're not the only firm that does that, obviously, right? There's a lot of good firms out there that work the way we do. So
yeah, I don't know if I'm willing
for everybody, but I just think it's important. It's an important distinction, and I feel like over the next 10 years or so, that's going to be where the industry heads, because I think I think there's a large disparity between what the average person wants from their planner or advisor and what most of the industry provides,
or are even able to provide.
People just want good, unbiased advice that isn't colored by how the advisor will get compensated.
So that is one thing I learned over the last couple of years, and we talked about it before the end of last year because I was trying to do some tax stuff and some wealth planning. Not all accountants are the same. Not all attorneys are the same. Not all financial planners are the same, or advisors are the same. Not all realtors are the same. Okay? Get your team together. Get your smart, well thought out plan together, and get your realtor, get your accountant, get your tax person, your accounting, your attorney, and your financial people, and find the best ones that are going to help you achieve your goal over the long term. That is what we say all the time. We're here for the long haul. Well, if you need to sell now, great. We'll get you the highest price. But our goal is to max out your position as an owner, seller, or buyer. I think, Katie, you had one last thing.
So if someone has multiple properties, would you recommend them taking one off the table and just taking the profit, or keeping all of them? What would you suggest?
Yeah, again, it really comes down to, like John and I were talking about, understanding, what their goals are and things like that. But, if somebody, for whatever reason, would like to, kind of cash in, so to speak, and, pull some money off the table to do whatever else with, whether that be, reinvest into a potentially, a DST or another piece of property, or just hold it in cash or anything else. Again, helping them figure out, is that the wise thing to do? Again, how to mitigate the taxes, if we can. And again, without letting the tax tail wag the dog, and then what to do with the proceeds afterwards.
So Andrew,
going to help them along with their, with their longer term goals. But yeah, I mean, we see that, just as I'm sure y'all see it way more than we do, I'm sure. But we're seeing that too, where it's like, well, prices are sky high. So the value of the property that they invested in X amount of years ago is probably a lot higher than it was when they bought it. So, we get those questions a lot. And again, I feel like a large function of our role is just to help, clients make those decisions.
Sure.
And as a brief example, John knows I'm a story and examples guy, but, we had some clients come to us a while back, and the wife at the time had recently inherited a pretty valuable vacation property from her mom, who at the time had just passed away. And so they were on the fence. They're like, well, they get a step up in basis, so we could sell the property and virtually pay no taxes and then, reinvest that money elsewhere, or we're not opposed to keeping it and renting it out and including including the rental proceeds as part of their retirement income. And so by the time they came to us, they were like, look, we're about to flip a coin and do whatever the coin says because we don't know what the right thing to do is.
Bad plan.
And so, yeah, and we ran a what we call our lifetime cash flow analysis, and what that does is kind of show you how those decisions you make today will affect you long term, and shows you kind of a side by side comparison on, all right, if you sell it and reinvest it because they were going to invest it in in the rest of their investments in the stock bond portfolio, here's what that looks like, or here's keeping it and renting it out based on the rental history and what they should be able to net after it's all said and done from that on your monthly income. And so here's those side by side comparisons. And it was pretty clear based on their situation that they should keep the property and rent it out, and include the rental proceeds as part of their retirement income. But,
there you go.
So I mean, that was in their best interest to do, financially speaking. Now, if they would have said, yeah, we hear you, but we don't want to be, we'd rather just not deal with it. Well, then, okay. Well,
Different
then,
story.
Our duty is to help you make, provide the data to help you make those decisions.
Love
and
it.
then, provide you so you can make as an educated decision as possible. And then however it is that you choose to proceed, we'll move along, with those assumptions. But yeah, so I mean, you would hate, again, most people don't have the means necessary to be able to, kind of run that analysis. And so,
But
we
you
were
do.
able to give them the answers that they wanted.
You do, and your firm does, and so do we. Hey, Andrew, let me ask you this. How does somebody I'm assuming you're taking new clients. Is that fair?
Yeah, we do. And again, we like to do we want people to interview us, and we want to interview them. We want to make sure it's a good fit so everybody's happy moving forward. But yes, sir, we are taking new clients.
Cool. How does somebody get a hold of you if they want to get in touch with you?
Yeah, if they visit our website at atlasfinancialstrategies.com, they're able to, view our team, request a consultation if they'd like. Our phone number's on there if they'd like to get in touch with us. And
Perfect.
And then we can go down that road and schedule a consultation.
Love it. Love it. Andrew, love that you're here with us today answering those questions. Great info. Katie, you got anything?
Thank you, Andrew, for joining us.
Awesome.
Thanks
Andrew,
for
we'll see you,
having me,
bud.
guys. It was a pleasure.
So, Katie, did you know what a DST was?
I did not until I found out from talking to Andrew.
I know, weird, right? I knew it was out there. One of my real estate folks told me about it a while ago. DST, Delaware Statutory Trust. It's where folks can sell a property, do a 1031 exchange, not into another property, but into a whole new fund of properties. Could be commercial office buildings, could be Walmarts, could be Walgreens. I think Walgreens is a big one. A bunch of different things where you own part of a bunch of properties, kind of a fund, a REIT, so to speak.
Very interesting. Yeah.
And then the cool thing, I think, is you can sell out of your DST and buy back into, via 1031, into real estate. So a lot of folks right now don't know where to go. If I sell, there's no real estate to buy.
Another option.
Another option. Take a look at a DST.